And good afternoon, everybody. Good afternoon. Appreciate you being with us today for our live market, Minds of Markets live stream, midday market recap here, guys. Same as Tuesday. I am not on the floor behind me here that you see. This is just a background. Normally, I am standing in the S&P 500 options pit at the SIBO. I am on vacation this week, but still doing this, so that's what it looks like behind me. But if I was down there today, and I know this because I was talking to a bunch of my buddies down there, it is rocking and rolling. It would probably be a lot of noise in the background here. It's unfortunate that we don't get that today, but things are obviously really busy, and just what a change a week makes for volatility, for volume overall. This market right now is on, I would say, pins and needles, quite frankly, where just a week ago everybody was talking about where's the volatility, right? So it shows you how things can change so quickly. And, something that I always preach to you, preach to my students, preach to everybody is you buy that protection when you can and not when you have to, right? What do we mean by that? When you have the opportunity to buy downside or buy some VIX or whatever it is, you do it. You do it. You watch those charts and you watch those levels. And what I mean by buying when you can and not when you have to is you want to buy it when it's cheap, right? You always want to have insurance in this marketplace. You always want to have insurance, just like you have to have your homeowners, your auto insurance, whatever it is. And you want to get the best deal. So you buy it when you can, not when you have to. Please remember that moving forward here, guys. Even if you never use that insurance, that's the good thing, right? You don't ever want to use that insurance because that means the rest of your portfolio is probably doing great. So let's do a slight recap here. S&Ps, we just came off the lows. Literally about 20 minutes ago, S&Ps were down about 40 points on the day. This was after being up about 20 points earlier in the session. We're down about 25 points or so on the S&Ps. Volatility has skyrocketed, not just at the VIX, and I want to go into the VIX in a little bit to explain things to everyone, because we can see what the VIX, and let me bring up my charts here. Okay, we can see what VIX is doing here. Right now it's 1570. I did see it up over 16 earlier today, but remember, this is what's called spot VIX. So this is what is happening right here, right now, not what is going out in the future. Okay, so if I were to bring up a chart showing you the VIX futures curve, and that's something that we really need to look at. Okay, the VIX futures curve. So let me pull this in here. This is live VIX futures curve right now, guys. Okay, here we are. We can see that 1572, that's right where VIX is right now. But because it's futures, we would expect those prices to be higher going out into the future. And they are. Okay? But what's really interesting with the election coming up, okay, VIX futures were pricing in a pretty good pop out to October and November. This has been going on for months already now. But that big, what's called spike, or if you will, the slope of that curve, that is actually flattened out. So we were seeing the spot or the current VIX trading right around 11 and a half, 12, with those VIX futures out in October and November basically in the same place that they are right now, 17 and a half, 18. That's pricing in some of the election risk, which is not unfounded, it's not uncommon, but now you can see that spread between the current VIX price and that future price has narrowed. What that tells me and what that really signifies in the marketplace is that a little of that risk now, a little of that concern that traders, that investors have, it's in the near term, not so much going out for the election. It's still elevated, but that hasn't moved. The October and November VIX futures haven't moved. in about a month. So something to definitely keep your eyes on. You definitely want to keep looking at that. All right, we have a special treat here today, everybody. Let me get this off the screen. We have a special treat here today, and I'm going to bring in my good friend. And Steve, where are you? Where are you? I see you here, but I don't.
How are you, Scott? Can you hear me?
I can hear you well, but I don't see your picture coming up here. But I think everybody can hear you. If I can get my producer to help me out here. What's going on, Steve? Steve is the CEO and founder of Quasar Markets, and you guys are going to be hearing a lot about Quasar Markets in the upcoming weeks, month or so. This is a new platform out there that is going to absolutely just blow away this marketplace. But Steve, I'll give you a chance to tell us about Quasar Markets in a moment. What the heck is going on in the market? What is your take in the market?
To me, Scott, you and I have been in the markets about 33 years now plus, and I'll tell you, it's almost the same every single year, but there is a little bit of difference in this, and there's a convergence. The first thing you want to think about is that we always sit into what we call the summer doldrums. That's when volume starts to get slower. People go on vacation like yourself, and look, the truth of the matter is we slow down our trading because, well, we're out and about. We're not paying as much of attention. But we are also looking for news, and this news cycle is very hot. Yes, and you've got to couple that with the election, and my goodness, unfortunately, Trump being shot at. You've got people nervous about the markets, and that raises the volatility. And when you add that with low volume, high volatility, you're going to have big swings. And I think as traders, we need to take advantage of that. It's a very important time. And look, I've been listening to you a little bit. I just bought Taiwan Semi here, Scott.
Well, let's see if that thing rebounds a little bit. It was up earlier this morning, pretty good after earnings. It got hammered kind of mid-morning when there was some news that came out across the wires about China potentially invading Taiwan. We know the overhang from what came out in the last couple days about what Trump potentially wants to do, with semis and with chips. So that thing got hammered, but it is well off its lows of the day.
Yeah, when you talk about Taiwan Semi in general, the two things that I look at is the first thing is the exports of semis from Taiwan to the United States. And if you look at back in the year of 2000, right around the first of the decade, you saw that the United States had about 20 to 25% of the chip sector.
Excuse me for interrupting. We got you back on the screen now. Thank God I have my producer standing by here. So we got you now.
I appreciate that. I'm not wearing my Prosper hat. I probably should have been.
Oh,
But look,
man.
yeah, you know what? The fact is, Taiwan Semi is in the when you look at it from that perspective of exports of chips, right? The United States at right around 2000 had roughly about 20 to 25% of the chip market. Think of it like Intel and chipsets like that. Today, that's only about 10%. So we have to import a lot more chips. I mean, we're all using more cell phones, we're all using more computers, and Taiwan Semi is that company that actually produces it. I also say Broadcom as well, and you have to look at the sales of cell phones as well because they have double chipsets. But Taiwan Semi has interesting radio chipsets that I really like. Now we've talked about it from the IBM side of this before with quantum computing. You've got two things you have to think about there is how fast can they make these chips? How fast can they get them out to us? And is there still a demand for it, supply and demand, right? And if the Trump is saying, hey, I want to put on tariffs on everything coming in the United States, 40, 50%, that's a problem, Scott. So that's also going to hurt Taiwan Semi. And we've already seen that. But here's what I think is really cool. And I think you pointed out quite nicely. And this is what I'm talking about when I say, look at the volume, look at the VIX, and look at news. But you've also found a bottom here in Taiwan Semi a couple of days ago, and I think you mentioned that on Schwab as well. Look, I think you're absolutely right. I am long here. I just went more heavy than I was earlier now. I think that Taiwan Semi balances here. I'm going to take that $2 or $3 out of it and enjoy the profits and probably spend some in Chicago.
Which you are coming here like in 2 weeks, and we'll have you live with me on the floor for sure. I want to bring up a chart here, guys, of, there we go. This is the SPX. Okay, this is the S&P 500. And, I mean, man, there's been some times over the last, years, 30 years or so that we've seen just this straight moonshot up. Okay, we've seen that before. So to see this little bit of a pullback, and I call it a little bit of a pullback, right? The market's in shock of what happened yesterday, right? 70 points, whatever it was. What is 70 points, though, over this move, right? The market was ripe for this. So there is this little bit of a pullback here. Is it going to continue? I don't know. Is it going to continue? Maybe. But what we are seeing, and I'm sure you've all seen this in the headlines, maybe you understand it, maybe you don't understand it, but we've seen this sector rotation, right? And we've seen it in a big way over the last week, continuing today. What does that mean? Well, what drove this? Okay, and what drove the NASDAQ? Let me bring in a NASDAQ screen as well. What drove that over the last 6 months or so? The screen's blank. It's populating here because there is so much running here in the background. Hopefully in about 3 seconds we'll get the NASDAQ comp chart up here. Come on. Working pretty slowly. There we go. So what drove this? I mean, wow. Hopefully people were in this. What drove this? AI stocks. Whether you want to call it the Mag 7, the big guys, chip makers, whatever it is, right? And while these were leading the market, there was a lot of fear and a lot of concern out there that those were the only things leading the market. So what's happened over the last week or so, especially with now the odds of the Fed cutting rates in September basically at 100%, is there's some rotation. People are getting out of these winners that they've held on to for the longest time, and they're rotating into stocks that will benefit from lower interest rates. The small caps especially, the Russell stocks. There we can see the Russell, or IWM, which is the ETF for the Russell Index, that has lagged for the longest time. Okay, and that's populating here now. And you're going to see this spike up because over the last week or so, we have seen the Russell, the small caps, gain about 15%. So look at this. Look at this chart of the Russell here. Let me just put this on. This is a 3-month chart. So while everything else was going on, or was going up, the Russell, the small caps did nothing. Did nothing. Look at this. Literally, look at this. This is, let's see, from when the move started here. This is the 10th. This is a week ago. Today's the 18th. This is 8 days ago. Look at that move. That's the rotation. People selling out of their winners, buying into something that had lagged for a long time, and with the potential new landscape with the Fed lowering rates, okay, that's good for these small cap companies. Now think about that. Why is that good for the smaller cap companies, those companies that don't yet, don't have maybe a ton of cash in the bank? Well, think about it. Smaller companies, they've got to borrow money, right? They borrow money to put back into their business, to go into manufacturing, R&D, whatever it might be. Well, if they're potentially now going to be able to start borrowing at lower rates, boom, there it is. That's why you're seeing this spike up. That is where this sector rotation is. So a lot of people have asked me, and you can read, all over, and Steve, I'm going to ask you about this in a second here. A lot of people have asked me, is the tech trade done? Right? Everybody wants to know that, oh my God, we got to liquidate out of all our tech stocks now. Personally, I don't think it's done. This is part of normal rotation in the marketplace. Steve, what say you?
Yeah, no, totally. There's three things I think here. Number one is when you talk about the tariffs, you're right, and you're talking about interest rates, you're absolutely right.
Great buy on TSM, by the way. Here, this thing is almost back to unchanged on the day.
You'll be happy to know, Scott, I just got out at 170.50. I took that limit order and popped it, and I'll probably have to buy the first beer in Chicago now. But look, the truth of the matter here, Scott, is you're absolutely right. When the rates are lowered, right, it's a lot easier for companies to borrow. And you heard from Trump a million times talking about how he wanted to lower rates, and now he's told Powell that he doesn't want them to lower rates until at least after the election. There's a little bit of nervousness here in the markets, and I can't play that very easily. And I'll tell you, that's why you're seeing that sector rotation. They're not just pulling out of tech stocks, but they're going into stalwarts. They're going into the IBMs and the Walmarts,
Yep.
things that older people are in, 401ks are in. You're seeing McDonald's possibly coming in here. This morning we saw Domino's Pizza selling off. Guess what I did? I picked that up on the bottom. Look, I think you're going to see a sector rotation continue into the stalwarts. Things that also, Scott, that when you have interest rates that are high, you want to buy stocks that are paying you dividends to keep you ahead above the interest rates moves. So that's what I'm really looking at when I look at stocks in the blue chip sector.
So are interest rates really high though? Come on.
No. No, they are not high.
Everyone is jaded.
But they are high.
Everyone's got the short memory of just where we were coming from, 3 years ago or so, when you were able to lock in a 30-year mortgage at under 4%, maybe even closer to 3%, when you were basically able to borrow money for free. That wasn't going to stay forever. And if you look historically, rates aren't that low. Rates here with the 10-year at 4.15, let's call it, 30-year at slightly above that, I don't know, 4.50 or wherever it is right now. Historically, rates are still pretty cheap.
Yeah, if you ask my parents, are rates low or high? They bought their first house with 16%, right? Back in the 70s. And when you look but here's the problem, Scott, rates are high comparatively to the people that are coming into the market now.
That's the kicker.
New influx of traders,
yes.
And they're not used to the rates being at 6, 7, 8%. They're used to rates being at 0 to 3%. So yeah, 5.5, 6, 7, 8% is extremely high to them, right? And they see the difference. They're a lot smarter now. They know that every point that gets added to a $500,000 jumbo loan is roughly $2,000 to $2,000, right? So that's that's real money that's coming out of the market, and that's money that they're not being able to buy Apple iPhones. They're not being able to buy computers, right? And that's discretionary income. So when you look at buying stocks, I'm sticking away from discretionary income stocks, and I'm looking at stocks that maybe are are preparing for the future in technology, like an IBM or like a Broadcom, or in this case, Taiwan Semi. So yeah, I think it's a good. But there's just too much nervousness right now in the markets. There's too low a volume. It's summertime and the election. There's just too much going on. And I have been doing what I have learned to do since a kid, is how to scalp. And I think that's literally the key right now, is learning to be in and out and not be, quote, wedded to your investment.
Yeah, you've got to be very on the move. You've got to be very actionary instead of reactionary, and,
right.
And you got to be able to move quickly. I totally agree with that. Now is not the optimal time to sit and hold positions, in my opinion.
And if you do, you better have tight stops on. I mean, I can't tell you how many stops I put on all of it. And I'm not a normal person who puts stops on, because I believe in my positions a lot of times, and I don't change those when I swing trade out unless I am, in this case right now, I'm very nervous myself, and I'm not a nervous trader. You and I have been in the pits a long time, and I can tell you one thing that I really, it scares me more than anything, is when we went from not having to trade based on tweets to back to trading on every tweet that comes out of Trump's mouth. Good or bad, I love it, but that makes traders nervous. And when you get nervous as traders, then you don't know. I mean, you have philosophies of the Democrats and the Republicans, and I don't like to trade based on who's in office. I like to trade based on what we know and what's being done, as opposed to what's being said. But we are back to trading the tweets. So you better have a tweet deck on. You better be prepared.
And that's really, really tough for the retail trader. For the market makers, the guys standing here behind me, and what I did for 30 years, you love that. You love that. But if you're sitting behind the screens like most of us are, and you're putting positions on, boy, that's tough, because there's so so much crap that hits the airwaves that can just move something in a nanosecond. So that
Yeah,
makes that.
when you teach to turn off the noise, and now we got to turn the noise back on.
Yeah,
It's unfortunate, but it
yeah.
is true. We
Get
are
get
trading
get
on
ready
that.
for it.
But
There's
but I blame you guys. I blame you options traders down there. You're the ones causing us most of the havoc right now. If you look at the zero DTE traders, I call them death contracts, as you know, are really causing a lot of havoc. We don't know, and
but
if you don't know,
that's retail. That's
that's retail.
retail. These guys behind me here, we're taking the other
They're not retail.
sides of the trades. We're not
Well, I have to
initiating.
ask but you have to ask the question, Scott. Why are the markets moving so much at 3:30 in the afternoon? Well, if the market's been pushing up all day and then it just gets sold off, well, that's those zero DTEs, and that's the option markets pulling
Well,
those options contracts.
there's no question about it. And what people don't understand, a lot of people don't understand, is when the equity markets close at 3 o'clock Central, 4 o'clock Eastern, the S&Ps still trade for another 15 minutes.
Yep.
They close at 3:15 Central Time, 4:15 Eastern Time. And so those zero DTEs, just like, and I'm going to draw something on the screen here,
Yeah.
just like every other option, what happens to every option as you get towards expiration? Okay, that theta, that decay goes like this. I'm drawing this big line here. So every option has what's called extrinsic value or premium priced into that option. And really, there's a bunch of factors that go into it, but the two major factors that determine how much premium is A, the amount of time left, and B, volatility. So as we get closer and closer to expiration, we see that time premium implode. Well, with zero DTEs, because they only have a day to go anyway, as you get towards the end of the day and those expire, that implosion of premium happens so quickly. So we do see that. And again, because the equity markets close at 3, but the S&Ps have an additional 15 minutes, you can see some really big movement in that last 15 minutes, because you got to also remember, Steve, that institutional traders out there and some of the big firms, when they're trading S&Ps, they're trading zero DTEs, they're maybe hedging against another basket of stocks somewhere or whatever else. Well, if that potential hedge has cut off and now you're left with only holding the one asset class or the one trade that's got another 15 minutes left to go, you can see a little bit more volatility there. So
And I'm telling you, I think with these kinds of options that are being traded and the volume that's happening at the end of the day, I like straddles happening. I would easily put a straddle on. And
you just
you're
got
going
to
to
be
say no.
careful.
I
You
knew
just
you
got
were
to
going
be
to say
careful
no.
with that implosion, though. That premium implosion as you get towards the end of the day. So we can do a whole session on zero DTEs another time. In fact, what I'm going to do, everybody listening in here, is when I'm on the floor back next week, because I'll be back in Chicago on the floor next week, I'm going to pull one of these traders. I'm going to pull one of these guys behind me in to the live stream, and they can describe to you what it's like to trade the zero DTEs in the pit, because it's been an incredible product for the SIBO. And these zero DTEs now account for just about 50% of all volume in S&P options, which is absolutely crazy. Absolutely crazy. A lot of people that don't understand them think they've caused excess volatility, think they have caused the VIX to no longer be relevant. I'm not one of those people.
No. They have not caused it irrelevant. I think but I do think that if you're going to trade zero DTEs, that you need to understand what you're buying and understand theta, time decay, because we're seeing a lot of people just using them as lottery tickets, Scott. And
well, that's what
me.
people don't understand them for sure. The retail trader out there is using them for the most part as a lottery ticket.
And if you're long TSM, here you go, 171. It just popped there a little bit.
Bingo. All right, let's go back to something here, Steve. What I have up on the screen, we were talking about interest rates. I have the CME FedWatch tool up on the screen. What this is, guys, and you can find this data on your own if you go to the CME website. It's called the CME FedWatch tool. This gives you a real-time assessment of what the marketplace is trading on of what interest rates are now and interest rates are potentially going to be in the future. The Fed has their next meeting July 30th and 31st. So at the July meeting here, okay, 95% probability they're not changing rates. They're going to keep the target rate, the current benchmark, 5.25 to 5.5%. But what has happened over the last week or so, specifically at the end of last week when we got CPI, PPI, here's now September. September is now baking in a 98% probability of a hike, of a cut in rates. 93% that they're going to cut by a quarter, and there is a 5% almost chance that they're going to cut by a half point. This ain't going to happen. No way, no how. Way too close to the election for that. Way too political for that. This.
Are you saying no cut?
No. I'm saying a 50 basis point cut. No chance.
That's too high. No.
A quarter cut, yes, that is going to happen. Personally, I think it should happen right now. I've seen enough.
Last month, but
yeah,
you're right.
I've seen enough eco data that shows that things are.
But that's just it, Scott. You and I see the eco data faster than I guess the Fed is watching, because now we're seeing jobs losses are picking up. We're seeing major companies cutting not 10 or 20 jobs, but 200 and 300 and 400 jobs. The Fed could have stopped that, right? We could have seen rates cuts because now we're seeing home prices fall too fast. Now, way too many things going on. And I'll tell you, if you want to show a chart, I can't see it in front of me, but if you want to show tens and twos to everybody out there, we are still negative on that.
Yeah, it's still inverted.
It's still inverted. Like, what is going on with it? The last time that we had an here's something for you, Scott. You want to talk about politics? Last time we had an inverted curve this long was 1980, and we had a guy named Ronald Reagan become president then. So listen, I tell you, this is starting to feel a lot like those years.
Yeah, it's
and I wasn't born. I was born in '73, so
economy, and. There's a lot that the Fed doesn't understand. There's a lot that we don't understand. And here I've now got this chart up here for the 10 and 2 inversion, which we can see on the screen here. The problem with the Fed is their data dependency is what's happened in the rearview mirror, not looking forward.
Right.
That's the problem. We have the ability to look forward, and we understand what is happening when they're basing their decisions on old data, and it's unfortunate.
Yeah, anyway. And, I just talked about 1980, but 1980 and 1989 and 2000 when the .com and 2006, and of course right here with the when we had COVID, these are bad periods in our time, and I think that's how people are starting to feel it. They're literally with an inverted curve this long, and it's been this long. Yeah. I think we're going to really come into a recession. I've been saying that. I hate to say it, but we're going to be in a recession, and I think people need to understand that. So I think that's why you're seeing a lot more sector rotation as well. They're protecting their portfolios. They're not just playing crazy meme stocks like AMC and GME. You shouldn't be doing that, right? Right now, this is the time to protect your wealth, because quite frankly, this is what's happening, and we're now in a weirder time with the election. And the last time that happened was in 1980, Reagan was shot. So I mean, we're talking about. There's a lot of things that are looking the same here, and I'm gonna tell you right now, I think that the Fed better start cutting and better start cutting quickly, or we are going to have problems. And I don't know, maybe you are right, Scott. Maybe 25, 25, 25. I don't think they stop. That's one of the things that everybody needs to understand is when they start cutting, they won't stop cutting. They always continue.
I totally agree. We saw the ECB this morning. They came out, they left rates unchanged, and they've already cut. You got to remember, they've already cut a couple months ago. They left rates unchanged. Today, they said they're most likely going to cut in September. They have 2 more cuts ahead, most likely. I think we absolutely need it. But besides, you were talking about what's going on here with the election. Just think about everything, the overhang to the market. The election, the Fed and interest rates, geopolitical risks. Come on, I mean... There's, we've got a lot of time left in the summer here, guys, and I think this volatility that we are now seeing, not that it's going to spike higher from here, but I would expect volatility the rest of the summer to remain higher than it typically is. What about you, Steve?
Yeah, I mean, I think the question has to be asked, and I've said this a million times. I'm more focused on the CPI data. I'm
Well, we
more
get
focused.
PCE next week. So
That's right.
PCE, that's the Fed's preferred inflation data. We
Yeah.
get that one next week. That's going to be a big one.
I mean, inflation is the key, right? Inflation has been the talking points in both sides of the political spectrum, and people are pissed off. Inflation has been too high for too long, and right now, I'll tell you that is exactly what's keeping up the market. If you ask me anything, it's corporate profits, because with inflation being up, corporate profits are all-time high. So
Yep.
this is not a presidential problem. This is a human problem and a business problem. When you have corporations making this much money, this is why the stock market's up, because they are making that money. And when they're not beating them on the, so when you look at earnings releases, it's not about did they beat or did they miss. I'm always looking at one thing. It's guidance in the future.
Guidance.
And they're
Guidance.
not saying good guidance. That's what's bothering me, because they're nervous too. We're talking about some of the biggest people on Wall Street are nervous. If they're nervous, then I'm nervous. And I think that's why I'm looking at CPI data, especially. And I'll tell you one place I've been looking for a lot is in the two places is in food and fuel. You have a couple things going on in food. You're in the summer, right? So corn harvest, rice, wheat, those harvests are coming in. And I think you guys in Chicago just had a tornado, right? I mean, the weather in the plains
We
have not been good.
literally had a tornado in Chicago proper, in
Crazy.
downtown. That never happens.
Right. I mean, that should have happened, right? But here's what I'm really looking at, and I think everybody should pay attention to this one, is food costs in restaurants. Are people still going to be spending money in the restaurants? Are people still going to restaurants? Are they going to continue to buy drinks and food? And then the second thing is getting there, right? Is fuel. And fuel costs have luckily have remained about the same. Oil still now right around right now 81.60 a barrel. Those two things right now are the main staples of humanity, right? You've got to get
What's
food.
really interesting with fuel costs, and then we're going to wrap this up, is
Yep.
even though the price per barrel of oil has remained elevated above 80, 82, whatever it was, and we saw a spike in gas prices weeks ago, I've seen the price of gas come down considerably over the
Yes.
last couple weeks.
Yes, agreed. The crack spread has definitely weakened there a lot. If you don't know crack spread, I think Scott Bauer explained it to you. You're starting to see heating oil too. That if you want to go in the futures right now, we can talk about that. But I think heating oil and natural gas could see a nice spike going in the winter. Whenever you see as warm it is down here in Florida, and we're already seeing first hurricane already went through. That's a bad sign. You're going to see a very, very cold winter, I think, this year, and that will push natural gas and heating oil prices up.
Well, that'll be good for me out here in Colorado. Hopefully, that means a lot of snow also. Steve, we can reach you and reach Quasar. I'm going to post it up in the chat here at quasarmarkets.com, right?
Yeah, I got some exciting news to tell you, Scott. In about 2 to 3 weeks, we will have the new platform, the one that I've always wanted to build, will be coming out, and I'm so excited about that. And we'll be probably around the 6th or 7th of August. You will see something that you'll be able to talk to the machine. You'll be able to ask questions in AI and have data from everything from what we talked about here all the way to sports and leisure. So I'm excited about the new platform, and thanks for mentioning it.
Awesome. Thank you for joining us today, Steve. Listen, 2 weeks from now, you're in Chicago. We do this live on the floor together. Thanks again, buddy. Really, really appreciate it. And everybody, appreciate you joining in for today's live stream of Minds of Markets. I will be back live in Chicago next week. So we'll see you next Tuesday. Have a great day, everybody.